And so now we've identified the dilution from options. The next challenge is are there any other potentially dilutive securities? And so you have to go in and you have to look. And really the easiest way to look is to start with the balance sheet. And so we go to the balance sheet and see, do we see any preferred stock or convertible stock? Let's find that balance sheet. 10Q, the financials are usually front and center, so it's in the first couple of pages. So here, for Apple, if you recall from the financial statement modeling course, there's no real preferred stock. Apple doesn't have preferred stock. They don't have any convertible debt. So there's nothing that jumps out at you as potentially dilutive that isn't common stock. But I do want to mention at this point RSUs, because we did see restricted stock units in that footnote 9. So companies are moving away from issuing stock options and are moving towards restricted stock units, and Apple is no exception. Apple has 17 million restricted stock units that are outstanding as of March 29th. So it's actually significantly more than the number of options that they have outstanding. So the one thing to understand with restricted stock units is that they are actually not dilutive. They're already being they're either vested, in which case they become part of the basic share count, or they're unvested, in which case they're not included in the diluted share count, just like options that are not vested are not exercisable and just excluded from the share count altogether. So here we see that on September 28th, 2013, they had 13 million RSUs, and an additional 7 million have been granted over the last 6 months, and of which 3 million of this cumulative 20 million now has vested and is no longer an RSU. It's just become common stock. And then and some of them have been canceled. And so these 17 million RSUs are not vested yet. And so you could try to get cute and incorporate a portion of them, because obviously there is they will potentially be vested, and there will be likely a dilutive effect. But from a modeling best practice in terms of what you typically see in an investment banking model, it's sort of a black or white thing. Restricted stock units that are vested become part of the basic share count, so there's nothing to think about there. But then the ones that are not vested are treated exactly like unexercisable options, and that is they're just completely excluded from the share count, and no dilution effect is assessed from RSUs. So we can ignore that piece. I just wanted you to be aware of why we're ignoring it. So we're going to hard code a 0 in here. There is no dilutive impact from shares of other securities, so that our net diluted shares outstanding is simply the basic shares outstanding plus the net dilution from options plus any dilutive impact from other securities. We want to make sure we brought that into the calculation. So this is the share count that we're going to use to calculate equity value per share. And at this point, we can finally turn to the answer of what we think this DCF says about Apple. Diluted shares are 64. Let's anchor that cell. So we need it for both. So the equity value per share for Apple is between $830 and $850 per share. That is a pretty significant premium. The DCF is valuing Apple more than the market suggests it should. So if we look at this is trading at a serious premium to the market. Oh, let's do this. Let's calculate. Oh, sorry. And we're gonna phrase it a little bit differently. We're gonna phrase it as it is at a discount. The market is at a discount to the fair value. There's two ways of looking at it. Is there a is the market trading at a discount to the fair value, or is the fair value reflecting a premium to the market? It's one and the same. It just depends on from which perspective you take. So this is a trading at a discount to the fair value. So the market is trading at a discount to the fair value. 28% or 27% or 29%, depending on which terminal value approach you take. So the core of the DCF is at this point complete. I've talked about a couple of things that we're going to look at in just a little bit when we build our sensitivity analysis and really see how sensitive the model, the valuation is to certain assumptions. Where we're going to talk a little bit about refining the nominal free cash flow formula for those that are interested in sort of adding some bells and whistles to this free cash flow, to this normalized free cash flow figure. We can mess around with these numbers and see whether, if we apply a slower long-term growth rate like 2%, what does that do to the valuation? Obviously, it makes the valuation a little bit lower. But, and of course, if we change this multiple to something lower, that will get the valuation closer to what the market perceives. But ultimately, what this suggests is that these operating forecasts are really reflecting a, perhaps an operating scenario that is more bullish than what the market is giving Apple credit for. The other possibility, of course, is that this WACC, this 10% that we just hard coded, maybe the risks associated with Apple are a little bit greater than a 10% WACC, and that really becomes the next section for us, trying to get closer to properly quantifying the risks of investing in Apple. What are the risks of these cash flows? And perhaps that's what's driving the lower valuation. That perhaps investors do think that these are the cash flows the company will generate, but they're just attributing more risk to the potential risk to achieving those cash flows. The other thing that some investors have talked about, and some folks have talked about, maybe people don't really believe that they're ever going to be able to get their hands on all of this 150 billion, that at some point that the company will not really treat this 150 billion very efficiently. They won't make the most of it, that they'll squander it. And of course, if you think that you'll only get your hands on, that the company will basically destroy half of this value, say, and let's say there's really only $75 billion of value that you're ever going to see, well then, you become closer, it becomes closer to how the market is valuing. But really, even if you completely ignore the cash balance, they're still trading at a discount to the model value. So there's something here. Let's look at the discount. Let's look at the discount rate and see if that helps us sort of square why the market is valuing Apple so differently from the DCF. So that's the next step. At this point, guys, once you complete the option schedule, as well as the final piece of that fair value per share schedule, and then we'll move on to the next video.